Welcome to our deep dive into Tech Mahindra's strategic outlook for 2026. As a cornerstone of the Indian IT landscape, NSE Tech M is currently undergoing a massive structural transformation. We are looking at a company that is moving beyond traditional services into a high-margin, digital-first powerhouse. For investors and VCs, the next 3 years represent a pivotal window where operational efficiency meets the 5G supercycle. Today, we'll analyze why the 2026 horizon looks promising, focusing on revenue diversification and the leadership's commitment to returning value to shareholders. This isn't just about code. It's about a global enterprise re-engineering itself for the next decade of digital dominance. Tech Mahindra's DNA is rooted in telecommunications, and this remains its strongest competitive advantage. As we approach 2026, the global rollout of 5G and the transition towards 6G research are driving massive demand for their network services. Currently, telecom accounts for nearly 40% of their revenue. By 2026, we expect their 5G-related offerings to scale significantly as telcos modernize their legacy infrastructure. This specialized expertise creates a high barrier to entry for competitors and provides a stable, recurring revenue stream that is less sensitive to the general economic cycles affecting other IT segments. To ensure long-term stability, Tech Mahindra is aggressively diversifying into non-telecom verticals. We are seeing double-digit growth in manufacturing, BFSI, and healthcare. By 2026, the goal is to have a perfectly balanced portfolio where enterprise business rivals telecom in scale. The NXT.Now framework is the engine here, focusing on cloud transformation and AI-driven automation. This diversification strategy is designed to insulate the stock from sector-specific downturns while capturing the high-growth potential of the Industry 4.0 revolution. The enterprise segment is currently projected to grow at a 12% CAGR through 2026. One of the most critical factors for the 2026 outlook is the company's margin recovery plan. Management has set a clear target to reach 14 to 15% EBIT margins by FY26. This is being achieved through several levers, increasing offshore delivery ratios, optimizing the pyramid structure with fresh talent, and divesting from low-margin legacy accounts. For investors, this margin expansion is the primary driver for earnings per share growth. As operational efficiencies kick in, we expect to see a significant unlock in free cash flow, providing the capital necessary for both strategic M&A and consistent dividend payouts. Tech Mahindra is not just participating in the AI race, they are integrating it into their core service delivery. By 2026, their generative AI studio is expected to be a major revenue contributor. They are helping Fortune 500 companies move from AI experimentation to full-scale production. This pivot is crucial because it changes the billing model from effort-based to value-based. For VCs and partners, this represents a transition into a more scalable, software-like business model. The company's focus on ethically responsible AI also makes it a preferred partner for highly regulated industries like banking and government. Financial health is the bedrock of the Tech M investment thesis. The company maintains a robust balance sheet with a strong focus on capital allocation. Historically, Tech Mahindra has been a generous dividend payer, often yielding above the industry average. Looking toward 2026, the projected 8 to 10% revenue CAGR, combined with margin expansion, suggests a healthy upside for the stock price. With a consistent payout ratio and a disciplined approach to acquisitions, the company offers a balanced profile of growth and income. We are looking at a disciplined financial path that prioritizes long-term value over short-term spikes. Market analysts are increasingly bullish on Tech Mahindra's turnaround story. Current consensus estimates for 2026 suggest a target price range between 1,800 and 2,200 INR, depending on the pace of global economic recovery and the execution of their margin improvement plan. This represents a significant potential upside from current levels. The bull case scenario assumes a faster 5G adoption in emerging markets and higher than expected AI integration. Even the base case remains attractive due to the defensive nature of their long-term telecom contracts. Investors should monitor quarterly EBIT progress as a primary indicator of this trajectory. In conclusion, Tech Mahindra is a compelling play for those looking for a mix of stability and high-tech growth. Their dominance in 5G, aggressive pivot to AI, and disciplined margin recovery plan position them as a top-tier pick for 2026. For VCs and angel partners, the company's internal incubation of tech startups and its global reach offer a unique ecosystem for partnership. As we look at the next 3 years, the roadmap is clear: execution on margins and leadership in the digital revolution. Thank you for joining this analysis. The future of NSC Tech M is not just about keeping pace, it's about setting the standard for the next era of enterprise technology.